Hey, everybody. Welcome to the weekly stock market update. I'm your host, Mark Yegge. I'm glad you're here. It's a long weekend coming up. President's Day is coming up, so I hope you have some big plans to celebrate and have some fun. Summertime weather is coming, and I hope you get outside and enjoy it. We are having a red week, to say the least. So I think with all this crazy stuff going on in Washington, there's always something, right? Like there's always something. Let me share the screen. I think I'm sharing it, aren't I? Yeah. I'll share it now. There's always something crazy going on in Washington. So, what are you going to do? You got to, it's all part of the game. So we'll see what they do. They're probably going to figure out a way to freak everybody out. And then in 11:59, when the bomb's about to go off, they'll cut the red wire and everything will be fine. And we'll just print our money or print our way into oblivion. And that'll be bullish for stocks. Probably crappy for bonds because bonds are in a crappy market right now. We are in a red market. You see 4 red lights on the screen there. We are headed lower, I believe. We have a nice technical bounce today, but I don't think it's enough to withhold this 5 days of selling that we've had in a row coming into this debt ceiling negotiation, blah, 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 whatever, wars and debt ceilings. And it's all the same, guys. It's all the same news. I've been doing this for 40 years. It's all the same. There's nothing changing, right? So we'll come up with some kind of debt ceiling thing. Otherwise, we're going to default on a debt, which we're defaulting on anyway. When you raise money, just print it out of thin air and give it to everybody, it's inflationary. So you're just inflating your way out of the debt, which is what the Fed has always done. And it's enriched the rich and it's made us all poorer. It's just the way it is. It's the way it's always going to be until we make a change. So looking at the market, the NASDAQ is leading. The technologies are leading. If you know this, if you're an NVIDIA, Apple, Microsoft, Tesla, we've had a good run at it. You're looking at a gorgeous chart on the daily here on the NASDAQ. And I suspect that is in place. It's making up for all that down that we had in the bear market over the last year and a half. But the S&P 500 is healthy, but not as healthy. It's got some other stuff creeping in there. It's got some banks in there and some oil in there and, some recessionary, sensitive stuff. So the S&P 500's good, but not great. Okay, now watch things start to get worse. Look at this chart, right? This chart is just showing kind of, we bounced off the 50-day moving average. I guess that's good, but like we're bouncing off of 50 or the 200-day moving average, not the 50. We're bouncing off the 200. I mean, that shouldn't be happening. Like we shouldn't be near there. We should be extended like we are on the NASDAQ. So I suspect the NASDAQ and the Dow are going to be coming back together to gain some confluence. And then the New York Stock Exchange is even worse. Now we're below the 200-day moving average. It's not a good place you want to be. We need a recovery above that. I don't know if we're going to get it. I'm not Nostradamus, so I have no idea whether it's going up or down. I play the probabilities, but to me, this chart looks like it's heading lower. We broke through a swing point of that 15,055 from a couple of weeks ago. We did it yesterday and the day before, and now we are bouncing, but I suspect there's too much downside momentum. And I just do going into the summer. I don't see why people are going to be buying going into this debt ceiling negotiation. To me, the move is to the downside. So it's a mixed market. Good techs, decent S&P, okay, Dow, lousy New York Stock Exchange. And then look at this. The VIX spiked this week. It went from like 1550 to 20. That's a big spike percentage-wise. It's back down because the market's bouncing today. But this VIX is now telling us, hey, maybe there's a little bit of trouble ahead. I will point out that there's huge trouble in the bond market. And if you can't see the left side of this chart, but if you look at a 40-year, 45-year chart of the bond market, it was bullish. It just went straight up, not straight up, but on a nice angle all the way up for 40 years. Now we're going through a bear market in bonds. Why? Well, because we're defaulting on our debt and a soft default by just printing more money, printing our way out of these problems. And you can't just keep throwing free money at things without it eventually coming back to roost. It's happened in the 750 currencies that I and other people before me have studied, and it's not going to be different from this time. But we are the world's reserve currency, and so that will slow the decline, but not the demise. So what you're seeing, look at this. I just kind of drew some dotted lines here to show you just, this is the safe money, right? This was paying you 2.5% to be in the bond market. Oh, put some money over here. It's really safe, the brokers all say, right? but there was a 42% decline while you were getting that 2.5%. So if you're going to be in something risky, why not be able to be in something risky that might make you money if it goes up, not that crushes you when it goes down and while it's paying you nothing because it's supposed to be no risk. So this is a 42% decline that if you own bonds, you sat through last year. If you own any fixed income, you sat through it. Why? Well, what's going on now is you're seeing it try to come up and hit that 200-day moving average. I suspect it's not holding it. It's consolidating a little bit, but it's a down. It's going to make what I call a dreaded H pattern. That's, you can draw a line, like a little line where I've drawn that dotted line, and then you see the little hump in the little H. If you come from the corner of that dotted line up and back down to kind of where it's heading, if it heads down to that red line, I suspect this dreaded H formation is telling us it's going to go further. You can see a little dreaded H formation if you draw it from kind of the line there where the green dotted line is, where it spikes up at the top. You start the H, and then you see it pop up where it says 42%. That's the hump in the H. And then look what happens when it got to the bottom of the point in that H, right? That little N, it just dropped, right? It dropped a lot, dropped 25%. I suspect we're getting a very big dreaded H pattern, and that is not good. And that means that people aren't buying our bonds. So the Chinese quit buying our bonds. You're seeing a liquidity crisis in the bond market. Nobody's going to tell you, except maybe me. Maybe there's a few other of us that'll tell you, but that's systemically bad when people aren't buying our bonds because our bonds are getting cheaper, as you're seeing on this chart. All right, I'm going on way too long, probably bored you, but if you're into this and geek out on economics and macroeconomics, you see that we've got major problems, and a lot of this stuff is showing itself on the chart because of this debt crisis that we always manufacture every few years. One more stock I'll talk about, Tesla. It's in a consolidation right now. It's trying to hit that 200-day moving average. That's a big deal. That's at 195. It hits that 200-day moving average, and it does it on some volume, and it can stay above it. Now we're talking about a stock that's looking pretty strong. Right now, it's not looking incredibly strong, but it's building cause to go higher. I'm going to leave you with that. And I'm also going to leave you by telling you, go out, have a great weekend, hug the people you love, spend some time with the people you love, because that's what's important. All this money stuff is fine, but we got to remember what's really the most important thing in our lives, and those are the people we love around us. So hope you have a fantastic weekend. Thank you for being here. Hope to see you at the end of another short week next week on the Weekly Market Update. Take care. Bye.